Hey guys, what is up? Welcome back to my channel. In today's video, we'll be talking about Wallstreetbets Short Squeeze Explained. We'll be taking a look at what is Wallstreetbets, what is short squeeze, and the whole saga between Wallstreetbets and Wall Street. Recently, Wallstreetbets has been all over the news, be it on news articles, television, or even YouTube videos such as this. Wallstreetbets are everywhere on the news. So who or what is exactly Wallstreetbets? Wallstreetbets are subreddit where participants discuss about the stock market, stocks, and options trading. Subreddit is kind of like a forum on Reddit. For all you guys who are not familiar with Reddit, think of subreddit as Facebook groups on Facebook. Topics discussed on Wallstreetbets usually include trading strategies which tend to involve leverage and revolve around highly speculative stocks. But these discussions are not just discussions contained within the subreddit. These participants come together to not only discuss these trading strategies, but actually come together to execute them in the US stock market. And one such example where participants in Wallstreetbets come together to execute their trading strategies in this stock, Gamestop. With the huge following on Wallstreetbets, alongside their highly leveraged trading strategies, participants in Wallstreetbets managed to drive GameStop's price up. And GameStop's market value increased from $2 billion to over $24 billion in just a matter of days. And up till recently, GameStop's stock price has risen over 1,700% since December. That's a massive increase in stock price for GameStop. This is a screenshot for the price chart for GameStop. If you take a look over here, back in around December, GameStop's stock price was still below $40 per share. But that didn't remain for long. In the next subsequent weeks, GameStop's stock price managed to reach around $500. If you're watching this video and you're new to the stock market, this kind of rise in price for GameStop is not usually seen in the stock market. And for all you guys who have more experience in the stock market, you probably know that this kind of rise in stock price is rarely seen in the stock market. What is the reason behind this rapid rise in stock price for GameStop? There are certainly a few factors behind the rapid rise in stock price for GameStop. But perhaps one of the most important driver for the increase in stock price for GameStop is because of the short squeeze. And that leads us to the next part of the video. What is short squeeze? For us to understand what is short squeeze, we first need to know what is shorting. Shorting is the opposite of buying a stock. When we buy a stock, we profit when the stock price of the stock increases. But for shorting, it is the opposite. So when we are shorting a stock, we profit when the stock price decreases. Let me give you an illustration of what this means. On the left side of the chart, we have an example of buying. And for the right side of the chart, we have an example of shorting. Let's see how we profit in these two different situations. For the left side of the chart, let's say we bought the stock at this point over here, at point A. So we enter our buy position at point A. And after we bought, the stock price managed to increase in price. And after the stock price increased for a while, we decided to take our profits and sell the stock. Let's say we sell the stock at this point over here, at point B. When we are buying a stock, when the price of the stock increases, we profit from this increase. The profit that we make on our stock is the difference between the price that we sold our stock at and the price that we bought our stock at. The profit on our stock will be this difference. That is for buying. For shorting, it is the opposite. Let's say we short the stock at this point over here at point A. And after we shorted the stock price started to fall. As the stock price continues to fall, we also continue to make even more profits. And say we exit our position at this point over here at point B. Because we borrowed the shares from our broker to sell the stock at point A, at point B, when we want to exit our position, we have to buy back that stock. The difference in price that we bought the stock at point B and the point that we shorted the stock at point A is our profit. That's the difference in how we profit from the stock market when we buy a stock and when we short a stock. Now that we know how we can profit when we are shorting a stock, the next question is, how is shorting done? I briefly mentioned about it earlier on. To short a stock, we need to borrow shares from our broker. And the reason why we need to borrow shares from the broker is because we do not own any shares of that stock. And for us to short and sell that stock, we need to have that stock. Our broker will lend us the stock and charge a fee for lending it to us. When we want to exit and close our position in our shorts, we would then buy the stock and return it back to our broker. So if we manage to short the stock and sell the stock at a higher price than when we buy it back, we are able to profit from the difference. So the profit from our short position will be the difference between the price that was shorted at and the price that we bought the asset back at. Using the same example as before, if we manage to short the stock at point A, which means we are borrowing shares from our broker to sell the stock at point A, and after the stock price declined for a while, we decided to buy back our shares. And let's say we bought our shares back at point B. So our profits from the short position will be the difference between point A and point B. And that will be our profit. Why do some traders in the stock market short stocks? There are a few reasons why people short a stock. and I'll be sharing with you the two main reasons why. The first reason is that they believe that the stock price will fall. If you've been following my videos for quite a while now, you know that the stock market does not always rise in price. There are three main directions in which stock prices follow. The first one that most of us know is upwards, the second is downwards, and the third is sideways. If we only buy stocks, we will only be able to make money when the stock or the stock market moves upwards. But if we add shorting to our arsenal, then even if the stock or the stock market falls in price, we will also be able to make money during that period of time. That is the first reason why people will short a stock. The second reason is to hedge their positions. Okay, now that we understand a little bit better about what is shorting, we can now take a look at what is short squeeze. Short squeeze happens when the price of an asset moves sharply higher, forcing traders who shorted the stock to buy back the asset to avoid heavier losses. So remember earlier on in the video, we talked about how shorting works. When we are shorting the stock or selling the stock, when we want to exit and close our positions, we have to buy back the stock. And this additional buying from traders who are closing their short positions further adds to the upward pressure on the asset's price. Let's take a look at an example of how this works. Say that back when Gamestop stock price was below $40 per share and it was just starting to rise in price. Let's say the demand for the stock at that point in time was 5 million shares and the supply of the shares at the time was 3 million shares. And because ultimately stock prices are determined by demand and supply, when there's a greater demand compared to supply, the price of the stock will rise. And with this rise, short sellers who shorted the stock will now look to close their short positions. Because as the stock price rises, short sellers start to lose money. Remember, shorting is the opposite of buying. When the stock price increases, we make money when we have a buy or long position in that stock. However, for shorting, as the stock price increases, we lose money. As the stock price increases due to the greater demand relative to the supply of the stock, these short sellers start to lose money and they will look to exit and cover their positions. And they would have to buy back the stock. And when they have to buy back the stock, this creates further additional demand for the stock. As the stock price increases, there's even greater demand for the stock relative to the supply. As the stock price increased by a fair bit, the demand now for the stock is 7 million shares, and the supply for the stock is 1 million shares. And this increase in demand is partly due to the short sellers needing to cover their short positions. So at this point over here, demand outstrips supply by a lot. And that is how a short squeeze works. In normal circumstances, stock prices increase because of the demand from buyers. But for a short squeeze, on top of the demand from buyers, there is an additional demand for the stock by the short sellers who are looking to cover and exit their positions. And these twin forces, when combined, can send a stock price rising up very fast. And that is what we saw happening in GameStop. There was a short squeeze on GameStop stock. And the short squeeze pitted retail traders or Wallstreetbets against the hedge fund managers and professional money managers. Back before Wallstreetbets took an interest in GameStop, there were a number of hedge funds and professional money managers, also known as smart money, who shorted GameStop shares. The participants in Wallstreetbets noticed that there was a heavy interest in shorts in GameStop shares, and these retail traders decided to pit themselves against this smart money, and they started to come together to buy shares and stock options. So as these retail traders pushed the price up through their buying, the smart money were forced to cover their short positions to contain their losses. And when this smart money have to cover and exit their short positions in GameStop, the buying by the smart money to cover their positions adds to the buying and creates further upward pressure on stock prices for GameStop. That is one of the reasons behind the meteoric rise in GameStop's share price. Hopefully after watching this video, you will have a clearer idea of how shorting and short squeeze work and understand the drivers which cause GameStop stock price to increase and increase so rapidly. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel, make sure you subscribe to this channel because each week I release new videos about investing, trading and the stock market. I'll see you in those other videos. To your financial success.